Hi, everyone, and welcome to another Good Governance event. It's really such a pleasure to see so many of you joining us from around the world for today's Good Governance Academy Colloquium. It's our 14th, which means we've had 7 years of colloquia happen in May and November every year. My name is Carolynn Chalmers, and I have the privilege of serving as the CEO of the Good Governance Academy. And really, thank you so much for making the time to be with us today. For those joining for the first time, the Good Governance Academy, or the GGA, is a not-for-profit initiative that brings together academia, business, civil society, and regulators to share governance knowledge and build capacity across the world. We're closely aligned with over 200 support member organizations representing over 4 million people in 167 countries. And today, one of our support members is our key support member for this event, and that is the AICPA CIMA. We're really happy to have them as a key supporter of this event in particular. The Academy's purpose is simple: to make governance education accessible to everyone, everywhere. Through our webinars, our colloquia, and collaborative learning programs, we bring together leaders, academics, and practitioners to explore emerging issues from ethics and sustainability to technology, leadership, and the future of boards. If you haven't yet joined our community, I warmly welcome you to do so. Membership is completely free, and it connects you with a global network of professionals who care deeply about good governance and sustainable leadership. You'll receive invitations to our upcoming events, thought leadership resources, and opportunities to participate in our collaborative learning initiatives. You can register quickly and easily at goodgovernance.academy. Before we begin, let's just take a quick moment to familiarize ourselves with the tools available to you on Zoom today. Our reactions. Please feel free to use the reaction buttons throughout the session just to show your encouragement and appreciation. Our events are very conversational in nature, so please, in the chat function, tell us where you're from, where you're dialing in from. It's always inspiring to see how global our audience is. And if you'd like to connect with others, you're most welcome to share your LinkedIn profile in the chat. The Q&A function. If you have a question for the speakers, please post it in the Q&A so we don't lose it. This ensures that your question is seen and doesn't get lost in the chatter. And we do welcome all chatter in the chat. Please do engage in the session today. A very special announcement, our translation captions. From now onwards, you can enable live translation captions in the following languages: Afrikaans, Arabic, Chinese, Dutch, English, French, German, Hindi, Italian, Japanese, Norwegian, Portuguese, Spanish, and Turkish. Simply click the CC button at the bottom of your screen and select your preferred language. I should be speaking in Japanese for some now. Thank you once again for joining us and for being part of this international movement to advance governance and leadership for a better world. Please sit back, engage, and enjoy what promises to be an inspiring and thought-provoking discussion. It's now my great pleasure to hand over to Professor Mervyn King, our founder and our patron, who will guide us in setting the scene for today's session. Thanks very much, Mervyn.
Thank you, Carrie, and thank you to AICPA for joining us on our 14th Colloquium on an important topic, namely the geo-economic consequences of the fractured world in which we are living in at the moment. Who would have thought when we were trading quite freely in a globalized world that we'd actually be in a very restricted situation with increased trade tensions and the weaponizing of tariffs resulting in increased costs of trade, international trade, and increase to the cost of living. Trade decisions today are also being made on geopolitical lines instead of looking at economic and sustainability lines. directors are concerned about the impacts on their companies from the geopolitical issues around the world. Up to 3 years ago, we were trading quite freely in this globalized world without any wars again, as we had during the Second World War. And suddenly we have three great wars. We have Ukraine, Sudan, and of course, in the Middle East, Hamas and Israel. And those all have consequences for international conglomerates especially. And there's a growing tendency to use trade policies to try and achieve non-trade objectives, such as climate change, human rights, and sustainability, which is rather skewing issues. So geopolitical impacts are forcing diversification of supply chains, localizing production, and there is a panic amongst companies to be ahead of the game from a technological point of view in this very fractured world in which we are steering limited liability companies today. So in risk management frameworks, we have to today, as directors and as boards, the collective mind of the board, has to include in your framework, your risk management framework, the question of the impacts on your company of these geopolitical events around the world. In addition, cybercrime is on the increase, and the cyber criminals are not only breaking through firewalls to gather information and claim ransom, but they also now are busy with regime change. Now, the change of regime and the nature of how a country is operating could have a huge impact on international trade. So we are really living in, as we've said in our topic, in a fractured world, rather than a harmonious, globalized, sort of free trade world which we were trying to achieve, which we in effect were enjoying until the Trump administration started weaponizing the question of tariffs. So we have a lot to talk about. And one thing I can assure you, I'm not going to say enjoy the colloquium, but I will tell you that you will be more informed about this so that you can add the question of the geopolitical impacts on your company to your risk management framework. It gives me pleasure as part of the opening to introduce you to my friend and colleague of some 40 years, Dr. Reuel Khosa. Dr. Khosa and I have worked together on the question of governance for about 40 years. And Dr. Khosa is one of our preeminent business persons in South Africa. Last night, he and I were together at the Sunday Times, our most important newspaper. Every year they give awards to the Businessman of the Year, the Life Achievement Award of a business person in the business world in South Africa. Dr. Khosa is a Life Achievement Award winner. He's Businessman of the Year winner. As was acknowledged last night, I was Businessman of the Year in 1987. I don't know where you were all in 1987. But that's when I was Businessman of the Year. But Reuel has got many distinctions. And one of them is president of our Institute of Directors, and I'm the vice president. I was the vice president. I was supposed to become president, but I insisted that Reuel should become chairman because of various factors that were present in South Africa at the time. And Reuel said to me, no, I can't be your president because you've taught me so much and you've mentored me. but I can't be your president. But he is now my president. I'm still the vice president. But it gives me great pleasure to introduce my friend and colleague and renowned businessman internationally, Dr. Reuel Khosa, to say a few words on our topic of our colloquium today. So, Reuel, over to you.
Well, thank you very much, Mervyn, and thanks a lot to everybody present. If you allow it, I'll start with a very brief prelude and then move on to my contribution for the afternoon. South Africa gifted two world-class icons to humanity, Nelson Mandela and Mervyn King. The former, a global moral leader, African humanist, compassionate visionary, and what I consider to be an epitome of political leadership in practice, a consummate reconciler. The latter, namely Mervyn King, pioneer and international doyen of corporate governance, and founder of the Good Governance Academy. I have had the singular fortune of having been mentored by both these global icons. Mervyn, for the honor of inviting me to this essential global dialogue on governance, leadership, and resilience, my gratitude defies limits. My focus for the afternoon will be on stewardship in a fractured world, confronting geo-economic risk with moral imagination and strategic resolve. Ladies and gentlemen, esteemed colleagues, custodians of enterprise, we gather at a time when the tectonic plates of global commerce and diplomacy are shifting with unnerving velocity. The world, once tethered by the promise of globalization, now finds itself fractured, riven by trade wars, punitive tariffs, cyber incursions, and the capricious dance of shifting alliances. In this milieu, geo-economic risk is no longer a distant thunder. It is the storm at our doorstep. To lead in such times is not merely to manage. It is to steward. It is to summon moral imagination and strategic resolve in equal measure. May I focus briefly on preempting the tempest, foreclosing on undue disruption. Conflicts, whether kinetic or economic, do not announce themselves with courtesy. They disrupt, they erupt, they dislocate supply chains, amplify reputational vulnerabilities, and expose the soft underbelly of our cyber defenses. To preempt is to perceive. To foreclose is to fortify. Boards must therefore cultivate a vigilant posture, one that anticipates the tremors of geopolitical discord and inoculates the enterprise against contagion. This calls for scenario planning that is not perfect, but essentially prophetic. It demands intelligence that is not merely informational, but interpretive. May I move on to briefly address embedding resilience, governance as a strategic asset. Geo-economic risk must be integrated not as an afterthought, but as a cornerstone into enterprise-wide risk management frameworks. This is not the domain of compliance officers alone. It is the sacred duty of boards and executive management. We must strengthen internal controls with the same fervor we apply to financial stewardship. Governance must evolve from a procedural necessity to a strategic asset. Sustainability and resilience are not parallel pursuits. They are intertwined imperatives. Let us not be seduced by short-termism. Let us instead enshrine long-term value creation, rooted in ethical leadership and institutional integrity. May I focus briefly also on adapting with agility and viewing opportunity as and opportunity in disruption. In every fracture lies a fault line of opportunity, I submit. Cooperations that adapt with agility, those that diversify supply chains, localize production, and embrace digital transformation will not merely survive, they will thrive. This requires a shift from reactive adaptation to proactive positioning. It calls for investment in talent that is geopolitically literate, technologically adept, and ethically grounded. It demands that we see disruption not as a threat, but as a crucible for innovation. A culture of awareness is not cultivated by chance. It is curated by choice. Geo-economic intelligence must be woven into the fabric of board deliberations. It must inform strategy, shape policy, and guide capital allocation. Executive leaders must be equipped not merely with data, but with discernment. In moments of uncertainty, it is not the abundance of information that matters, but the clarity of insight and the courage to act. Let us therefore build institutions that are not only intelligent, but wise, not only responsive, but responsible. May I conclude by focusing on stewardship in the age of fragmentation. In closing, I invoke the wisdom of Ubuntu, that profound African philosophy which reminds us that our humanity is bound up in the humanity of others. In a fractured world, interdependence is not weakness, it is wisdom. Let us be stewards of enterprise who do not merely chase profit, but who champion purpose. Let us confront geo-economic risk not with fear, but with foresight. And let us lead not with bravado, but with benevolence. May I thank you for the opportunity, and may your deliberations be discerning, your decisions be daring, and your destinies be dignified. I thank you very much.
Thank you.
Thank you so much. Thank you, Dr. Khosa.
Thank you.
Thank you so much, and thank you for joining us. Know that you had to take a special dispensation to recuse yourself from a board meeting to address us today. So thank you very, very much for that.
Much honored by the invitation. Thanks a lot indeed.
Thank you, Dr. Khosa. We're honored as well to welcome Michelle Mullen now, Vice President of Global Advocacy at the American Institute of CPAs, AICPA. In her role, Michelle leads the Institute's international advocacy efforts, working to promote and protect the public interest by advancing the global accounting profession. She engages with regulators, standard setters, and key stakeholders around the world to ensure that the voice of the profession is heard on critical issues, from audit quality and sustainability reporting through to technology, ethics, and the future of assurance. With a career spanning over 2 decades in public policy and professional advocacy, Michelle brings deep expertise in international collaboration and regulatory strategy. Prior to her current role, she held senior leadership positions within the AICPA and its global partner organizations, where she played a key role in shaping policy initiatives that strengthen trust and transparency in financial information. Michelle is known for her ability to connect policy with practice, translating complex regulatory developments into actionable insights for accounting and finance professionals. Her work continues to elevate the profession's role in driving sustainable economic growth and integrity in global markets. Please join me in welcoming Michelle Mullen. Thank you.
Carolynn, thank you so much. What an introduction. And I'll have to say, I also spent 23 years with the Institute of Chartered Accountants of Scotland, ICAS. And for those members who are on this call, I thought I ought to give that shout out. I'm truly delighted to be able to join you for today's colloquium. It's a real privilege to be able to speak to you today, because we gather at a time when the global order is undergoing a very profound transformation, not just in a single event or a single actor. It is a shifting power dynamic. What we've heard from our previous speakers, and just bear with me. Screen has just frozen on me. This is characterized by all the things that you see on this slide: regional instability, deepening economic policy shifts, regulation, the demands of being a sustainable business. And I use that term deliberately. We have talked about sustainability, but it is about being sustainable businesses around the world. And then we have the impact of accelerating developments in AI and technology. And all of these dynamics are interlinked in this increasingly volatile environment. And there's going to be a lot of similarity in this presentation with the previous speakers, because having a really good understanding of geo-economic risk is no longer a niche for policymakers, financial analysts, or people like me. It's a strategic imperative for all of us. And I've seen from the chat, many of you are attending from all over the world. And for those of you who are in the Eastern time zones, it is the wee small hours of the morning. And so good morning to you and good afternoon to everybody else. You are leading, you are governing, you are advising the businesses that have to navigate this landscape. They are asking you to help them mitigate the risks. And very importantly, they're asking you to find the opportunities. They're asking for your advice. They're asking for your guidance. They're asking for your scrutiny. And they're taking decisions at a time of unprecedented certainty. But surely the one thing that business is really good at and understands is that there is no certainty in business. There is only uncertainty. The difference, I think, is that the tempo has increased markedly in the last 5 years. And this landscape's particularly complex because it's all interrelated. So what do we mean by geoeconomic risk? Well, one definition is the intersection of geopolitical tension and economic consequence. So let me spend the next few minutes just reflecting on the environment that we are all dealing with today. We are witnessing global power shifts. Their foreign and economic policies are now capable of changing on a near daily basis. Now, tariff and trades, they dominated the agenda for quite a lot of 2025. They probably dominated the discussions in most of your boardrooms since about April time. And there is still going to be some uncertainty over those policy shifts and the range of tariffs, both from a legal perspective and also from the final trade deal positions, because we all know the devil is always in the detail. But despite what I would say is the outward policy and diplomacy prevailing in the end, it is very, very clear that the developed economies are no longer as aligned as they once were. Mm. That creates uncertainty and risk for business, but it also creates opportunities for emerging economies, because many of them are a key part of the global supply chains. And then there's what I might describe as global upheaval, just general global upheaval. But in the wake of the pandemic, we all witnessed the beginning of a move away from global supply chains to more localized supply chains. You can still see that movement in domestic policies around the world. There is a growing focus in many developed economies on competitiveness, protectionist policies, and building self-sufficient supply chains. The cynic in me might say that that approach has been prompted by a desire for nations to prioritize their own resilience in geo-economic uncertainty. But the question is whether this is a short-term trend or a long-term trend that needs to be factored into strategic planning. Now, earlier this year, businesses were forced to review once again those supply chains in order to understand what all the shifting tariff policies meant for their businesses, their customers, suppliers, and wider stakeholders. Now, we have heard from an AICP and CIMA perspective that businesses sought to not only mitigate the short-term tariff exposure, but they used that detailed work as an opportunity to review their markets, to improve their resilience to general trade uncertainty, to consider the whole production line and supply chain, because they understood that the country of origin was more important than ever before. They developed the action plans that took account of possible production and product changes, supply chain diversification, inventory, pricing, currency, risk, taxation, transfer pricing strategies. That business resilience, I think, is going to be a key theme of our discussions today. But there are hard trends and there are soft trends. And the temptation is to focus on those soft trends that are of the moment, the trades and the tariffs. It is equally important to not lose sight of the hard trends, because they are not going anywhere and they're incredibly important to the medium to long-term horizons for business. AICP and CIMA has undertaken quite a lot of research and insight work along with experts in this field. We've identified 3 key hard trends: shifting demographics, technology, and regulation. And if I take demographics first, most developed economies are in population decline. In contrast, Africa is the fastest growing region in the world, with the
accessibility shortcuts.
I don't know what's happened here. Didn't like that prompting. Africa is the fastest growing economy in the world. It is projected to be accounting for more than half of global population growth by 2050. India, at the moment, over 65% of the population is under 35. Now that presents the potential to really accelerate growth and position the region as a skills hub. Skills is very, very important. Skills migration is very important for business, particularly as we see unprecedented levels of investment in AI and as technology continues to advance. Companies are recruiting from a global market and they're not just looking at a local market. This is an opportunity for business. But on the other side of the equation, we're already seeing governments looking to, let's say, safeguard against that skills migration, where it does not align with their domestic policy agenda. And that means that certain skills in certain industries are going to be an increased demand, and that may become an increased cost for business. The one thing we know is that the speed of technology is never going to be slower than it is today. So let me stay on that theme of AI for just a moment. AI is particularly prominent just now in the context of governance and ethics. Our members have shared with us from their boardrooms around the world that companies are still unsure about where AI will sit within the future corporate governance model and the future corporate business model. Now, for most companies, AI is a technology, and that seems to be where it is vesting for now. But there will come a time when AI is much more than a business tool. And then there are unanswered questions over the impact of AI on a business's future pipeline. We all know it's going to drive productivity. We all know it's going to allow us to produce much higher quality data insights in a fraction of the time. But how do we ensure that the next generation can build the right levels of professional skepticism and judgment that often come from experience built up over many years doing the very jobs that we expect technology to do? Our members also tell us that companies and boards are focused on some key issues. Geopolitics is actually number 5. The top 3 are the opportunities and risks posed by AI and technology in all of its forms, the associated cyber risks, and a third top topic is sustainability. All of these are interrelated. All of them are accelerating. And we only need to look at 2 of those areas, very briefly, to really understand some of the complexities that our businesses are facing. So let me take AI for a moment. It's on the front cover of the FT today, where senior business leaders are highlighting the challenges that competitiveness will encounter because of the regulation threat in certain geographies. This is a very fragmented landscape. These are not policies that have been legislated for as yet, but it is an overview of different approaches around the world. Some governments are very keen to balance risk and opportunity and innovation. Other governments will look at it from a risk-based approach. And it is the uncertainty of the shape of AI regulation, AI ethics, and the future capabilities of AI that are just adding another complexity for business. And the difficulty with complex and fragmented regulation is that it very often ends up as a cost for business. This is all happening at the exact same time as the sustainability agenda. And we have seen significant developments in sustainability reporting over just the last 2 years, with the international standards being adopted globally, subject in some cases to additional jurisdictional requirements. The EU is already reflecting on whether its policy vision can balance with the interests of EU businesses. And we're going to see the outcome of the EU sustainability agenda over the coming months. But let me just flag for you that there is another omnibus coming in Q2 2026 that will relate to taxation. And there will be elements and definitely headline policies in that omnibus that will impact businesses around the world. The point I'm trying to make is that it's my job to engage with governments and keep a watching brief on what's going on. Against the current geo-economic landscape, one of the biggest challenges for business leaders is actually just keeping up to date and deciding on what are the soft trends and what are the long-term trends, what needs immediate mitigations and measures, and what is part of planning and investment for the long term. Because business likes just enough certainty to enable it to plan for the future. So what does that mean for us? Well, to maintain some of the themes that we've already discussed, it means a focus on building resilience. The hallmark qualities of a resilient business are, as we've heard, fluidity, reinvention, adaptation, having less focus on managing risk and more focus on building a strategic mindset and planning. Because resilience is no longer about just bouncing back. It is the ability to absorb the shocks, to sustain operations and disruption, because companies have prepared for it and being very well positioned overall to seize any opportunities as they arise. Second, it's about redefining risk management, because the traditional models that we've relied on historically rely on historical data. And that is not going to be sufficient in a world that is just growing in complexity. We need forward-looking scenario-based approaches that account for political and economic volatility, that account for technological advancements, that have taken into consideration elevating risk and disruption and environmental stress. And thirdly, the current geo-economic landscape calls for accountability. It calls for transparency and strong ethical leadership, as we've heard. It also calls for strong governance. Because in a fast-paced world, there will be critical decisions being taken during times of increased pressure. And business leaders and board members want to be reassured that culturally, they're going to be made on an informed basis and for the right reasons. Governance is a very, very important pillar of any resilient business. It is a key pillar of a sustainable business, ensuring that there's a focus on value creation. Because true resilience, I would suggest, is forged alongside risk and responsibility. So the phrase we heard was, how do we thrive rather than just survive? AICP and CIMA, we're the largest accountancy body in the world. We have nearly 600,000 members in nearly 200 countries. We've spent a lot of time thinking about this. In April, we issued 5 actions for finance teams. And in July, we issued a business resilience toolkit. It draws together into one single source many of the tools and resources of public accounting and finance accounting and management accounting. And I've included all the QR codes because this landscape is complex and complicated enough. But there is a role, an important role for finance professionals. And I know that Lee and Stacey will maintain this theme. Driving stability and resilience in organizations. Because when businesses encounter external or internal challenges, and it doesn't matter whether that's economic uncertainty, shifting policies, financial instability, it's very often the finance team or a grouping that is asked to help guide the organisation, because it is armed with a very deep understanding of the business and expertise across strategy, risk management, treasury operations, cash flow, cost transformation, budget control. It is through a structured approach to monitoring economic uncertainty, adopting a strategic mindset and clearly understanding the business model and its associated risks, that organisations will identify the emerging challenges, the opportunities. They will connect the dots and really foster what we call integrated thinking. Because sometimes when the world gets very complicated, the answer is to keep it simple. And the toolkit is intended to take us back to some of the basics of strategy, risk management, scenario and planning, testing, and forecasting. Some of our members have told us that their companies, and these are global operations, that have very sophisticated teams with very sophisticated tools. They have been running more scenarios in the last 9 months than ever before. And often that is to take account of a policy construct that is just changing on a near daily basis. But the result is that those companies have a very strong data set that enables them to reassess the business model, to remain adaptable to the environment, and to take informed decisions about prioritization and allocation of resources so that they're in the right place at the right time. And those businesses have data insights that also support their long-term decision-making. This is my last slide. Let me close out on the topic of trust. Because if we take all of the themes that we might discuss today and we put them together, these are the themes of business and finance. And we all have a responsibility as trusted advisors in turbulent times, whether we are finance professionals in business, whether we're advisors in practice, or whether we're a global community of professionals with a common purpose, like this colloquium. Trust, transparency, and ethical leadership in times of uncertainty should always remain our North Star. So I'm very grateful for the opportunity to join you today, and I'm going to hand over to our next speaker, Lee White. A lot of that key theme in terms of our profession.
Perhaps,
Thank you very
Lee,
much.
if I can just do a brief introduction. Thank you so much, Michelle. You got lots of reactions. Just a brief introduction to Lee. So Lee is the Chief Executive Officer of the International Federation of Accountants. As CEO, Lee leads the global organization representing more than 180 professional accountancy bodies and over 3 million accountants worldwide. Under his leadership, IFAC works to strengthen global accountancy profession and enhance public trust and advance high-quality international standards in auditing, ethics, and education. Lee brings a wealth of experience in global finance, governance, and professional development. Throughout his career, he has been passionate advocate for the role of accountants as trusted advisors, helping economies grow sustainably and transparently. At IFAC, Lee has championed initiatives that promote sustainability reporting, digital transformation, and the public interest role of the profession in addressing today's most pressing economic and social challenges. A respected thought leader and collaborator, Lee is known for building partnerships across governments, regulators, and professional bodies to ensure that the voice of the global profession remains strong, unified, and forward-looking. And Lee, I haven't even mentioned your role at the ISSB. So thank you so much, and over to you.
That's very kind of you, Carolyn. So hello, colleagues. Thank you very much for your time. Probably the only thing, Carolyn, to add to that piece, if anyone is that interested, is about my passion for the game, the great game of cricket as well, as I know Professor King is. So perhaps I need to update a little bit of my CV to include that. But thank you, Carolyn, for the invitation, and genuinely thank you to the Good Governance Academy for giving me the honour to join the 14th Colloquium to share a few thoughts here today. I do need to thank particularly Professor King, who I've worked with for many, many years. It's been a great honour and a pleasure to always have engagement with you, Professor King. It was your foresight and leadership that led, as we heard earlier, to the founding of the Good Governance Academy, which is incredibly, and today shows us, doesn't it? It's an incredibly valuable mechanism to elevate good governance globally for all of what we would say is the right outcomes. And I might share a couple of aspects to that. So thank you very much, Professor King. I think my dear colleague Alan Johnson is also now on this call, who is the current chair of the Good Governance Academy. I've got to say as well, Alan has performed many roles for the public interest, and one importantly is a previous president of IFAC. And so it's inspiring to be able to work with you in this engagement, Alan, as well. So thank you, and hopefully you're feeling well. And again, I'd just like to recognise the panellists, all of whom have either spoken or will be speaking in the event today. Now, the topic I was given through that theme of geo-economic risk in a fractured world was to take it a little bit closer to the accountancy profession's role in navigating geopolitical complexity and, importantly, supporting business resilience and stability. And I think Michelle did a fantastic job of already opening that door and providing a huge amount of insights there. Before I come to that, I probably have three messages that I just like to share in the spirit around good governance. And I think some of the speakers have already touched on them, but because of the importance of these messages, I'd just like to highlight them again. Firstly, when we think about all of what entails good governance, for me, it's never about the rules. And I think if we think too much about the rules, I think the value gets lost. This is all about creating sustainable value and not just a compliance exercise. And we need to think importantly about the outcomes that are delivered from the way in which organisations engage with its governance activities, because you can see that there might be examples where all of the right processes, all of the right actions are in place, but it doesn't lead to outcomes. And so therefore, when we assess good governance, it must be outcomes based. Secondly, and I will use a word that I heard Professor King mention earlier in his opening remarks, where he used the word, perhaps there's some level of panic at this time. And what that throws up here for me is that we have a lot of discussion, a lot of focus on risk, even the title of our theme today, geo-economic risk. And that's important to do, that's appropriate to do. But I think where we need to ensure in these types of discussions and other arrangements, other conversations that we have to continue and advance good governance is to ensure that there is this level of balance of opportunities with risk. For me, good leaders need the courage and have the courage to demonstrate the pursuit of opportunities, not just always about the management of risk. And that's really tough. That's really tough because, you know, when you're absorbing so much information so quickly, and it's about what could this do? Could this be damaging? Could this be another, even a fatal action against your organisation? We need to continue to have the right mindset to balance all the heavy weighting of risk with that sentiment of opportunity as well. And the third point I'd like to make, and Michelle, in fact, I think all of the previous speakers made mention of this, is just literally the pace of change that is occurring. And the pace of change with our theme about geo-economic challenges, the context of that is very, very difficult. But I think it means, therefore, in reshaping, and perhaps organisations haven't done this as much, and this is where our encouragement today is to really build into your strategic frameworks geopolitical scenario planning. And again, I'm coming with tasks that aren't particularly easy to do. But if you have this aspiration, as we all do, to be resilient and to thrive, then that level of scenario planning, I think, is just now a must. It's not discretionary. It must be occurring. And as I said, that's not easy to do. So allow me then to come from those three broader remarks to a little bit more about the accountancy profession. And if we think about the accountancy profession in today's complex world, our mandate is evolving in sort of three areas. And you might notice with my remarks always, I try and keep things to threes because I always find that fairly easy to comprehend. The first is around connectivity. We see across, this is the accountancy practitioners, we see across all of the enterprise. We connect risks that might otherwise seem isolated. We see supply chain vulnerabilities, cyber threats, climate risk, financial exposures, much of what Michelle was including in her earlier insights as well. But we do have an ability to integrate these perspectives to help organisations mobilise the right responses. So the first is about us as connectors and connectivity. The second is, unsurprisingly, about trust. We anchor confidence among investors, employees, governments, and broader society through strong governance, sound assurance, delivery of assurance practices, and highly valuable decision, useful reporting information. And thirdly, transparency. We provide through our actions clarity amid levels of uncertainty, translating complexity into insight, and so that boards, stakeholders, and broader parts of society can make informed, forward-looking decisions. Simply put, again, back to the theme of today, thank you for putting that up, Carolyn. Simply put, back today to a fractured world, the accountancy profession is truly a foundation of strength. And I have the privilege, dear friends and colleagues, in the role that I fulfill, to have the opportunity to engage with many around the globe, whether it's through forums like this today or the opportunity for some face-to-face engagement. And you can feel the sense of uncertainty, the level of tension around the globe with the changes that have been occurring and will occur. But you can also feel genuinely many looking towards the accountancy profession for its level of certainty and stability, and then ultimately the flow on from those characteristics to a level of economic prosperity. Now, we should, as a profession, never take that for granted. We're not entitled at any time to that level of trust placed in us. We need to continue to earn it. But it does feel at this moment, with the level of change, the level of uncertainty, the accountancy profession genuinely delivers a foundation of strength and stability. Now, I might come to, in the time that I have left, to a few very specific roles that professional accountants undertake, and I try and set this back in terms of our theme. But I'd like to come first to the role of professional accountants in the boardroom. And this is an incredibly important part that our profession plays, occupying different roles in the non-executive community. But also, perhaps I'd like to draw out where our skills and expertise are drawn to audit committees, if there are risk committees, very much into those roles as well. And accountants will be involved in the thinking of continually improving better governance processes to safeguard the resilience and, as I said earlier in my opening remarks, about sustainable value creation. Now, we have an ability around coordination, alignment of strategic risk management controls and reporting processes to ensure connectivity and a clear understanding of how key risks are being dealt with, so companies, organisations can act carefully, fairly quickly, decisively, without compromising their long-term strategic competitiveness. And why I make this point is you can feel, with the pressure of the changes, the pace in which it's occurring, there is a tendency in terms of organisations to start to operate internally within isolation, perhaps with a breakdown between those charged with governance to the executive teams, all of which is unintentional, but as pressure continues to build, these sometimes are natural consequences of what may occur. And if you have the strength within the boardroom, within the different parts of the structures of governance, and I believe, importantly, with the strength of what professional accountants can bring, that will very much take the right steps to ensuring that that level of fracturing from the geo-economic down into domestic, down into an organisation, does not play through in the way that it potentially could. Now, what we do know boards are asking, what are the key drivers of risk and opportunity? And maybe I should reverse that in the spirit of what I said earlier. What are the key drivers of opportunity and risk relevant to our business? We spoke earlier about trade and tariffs, technology, security, energy transition. And in that sort of large list, what are the ones in which you need to prioritise? What should we act on now? What are the issues should we wait to act on? And timing, as we know, it's never a case of whether there's right or wrong, but it always feels like the challenge is getting the timing right. How do we assess exposures to key risks, make decisions on navigating the short-term uncertainty without necessarily veering from the strategy of the long term? And how do we, if we're able to, influence economic agendas through engagement on public policies and with governments and multilaterals? And those sorts of questions I felt were embodied into the toolkit that Michelle was sharing earlier, in which raises the way in which to convert these questions into duly what is important actions to take. So that's the boardroom. Let me then come to the CFO leadership. Accountants in finance will always be assessing the capabilities, their capabilities to address the speed of change, which importantly is to ensure that the financial stewardship remains very much steady and effective. For CFOs, the ability to provide strategic foresight and relevant insights with scenario planning, which is what I was just talking about earlier, a deep understanding of emerging regional and global dynamics is top of mind. Ongoing geopolitical dynamics, economic growth, trade tensions translate into disruptions, potential disruptions for revenue, operating costs, and constraints on strategic flexibility. So today's CFO and finance teams must be at the heart of guiding the good decision making and focus on where value is at the stake through strategic intelligence based on stress testing, scenario planning, challenging assumptions, capital allocation, and really clear communications and transparency. Now, as I said earlier, in times when perhaps the good old days, if I could say it this way, when there wasn't the same level of challenge with the pace of change, this was always set in a way that the CFOs, the finance executives were able to navigate. I still believe those core fundamentals are exactly what needs to be used now, but it does need slightly more of this mindset change to feel that what we're experiencing now, and perhaps someone would like to challenge this in the conversation, maybe this is our new normal now. That, you know, what we speak about in the past to where we are to now, and the pace is perhaps how we do remain comfortable that what we're experiencing is what will be in the future, and we need to be resilient in terms of that scenario. I'd love to hear your views around that. So I've gone from boardroom, I've gone to the CFO, the engine room. It would be amiss of me not to talk about the role of professional accountants in delivering audit and assurances, safeguarding confidence. We know assurance roles play an incredibly vital role in preserving confidence, particularly in a volatile and uncertain business environment. Geopolitical disruptions can increase estimations of uncertainty, perhaps impair valuations, raise difficult questions about going concerns. Whilst we've always had these challenges as a professional professional accountants delivering assurance, the intensity and perhaps the lack of track record makes it even more challenging now. So what are we known for as professional accountants in delivering assurance? Very strong professional skepticism and the use of our judgments. And what a better time to be known for a profession delivering in terms of the public interest and using these skills than now and looking ahead. Now, our earlier speakers, and Michelle touched on it as well, as correlating with these geo-economic challenges is also the rapid pace and change with AI. And I won't go deeply into that, but the piece here I just wanted to join up was there is some sense that, you know, what is AI doing in transforming audit? Clearly it is transforming the way in which assurance is being delivered, but it's not at the expense of those characteristics, those humanistic skills around professional judgment and skepticism. So I leave you with a very clear message in this space around assurance and audit that notwithstanding the level of changes that are occurring, this will continue to play an incredibly important role, irrespective of the geo-economic tensions, irrespective of the advancements and rapid pace of AI. And let me just conclude then by saying, you know, Carolynn introduced me and the role of IFAC. Very much we are truly a global profession. And I see our role very much that when there is times of fragmentation, to deliver as best we can unity. Our world needs inclusiveness, and the global accounting profession has been and will remain an inclusive profession. And in terms of the level of instability and uncertainty, we can provide even more than what we previously have done by being importantly about delivering stability and unity. Now, we will see national and regional responses to geopolitical uncertainty, and they're obviously understandable, but we do see they create barriers. Barriers to comparability and efficiency. IFAC continues to advocate for global consistency and cooperation. Clearly, this is largely in our space with international standards, something IFAC has always advocated, and we will passionately do that in the future as well, importantly with sustainability and broader corporate reporting. But it's always about enhancing trust in the information that's delivered and the assurance that comes on that, not about finding levels of division. So this is where our profession's unity truly matters. We can only build resilience if we maintain a coordinated global framework grounded in principles, informed by evidence, and guided by, importantly, the public interest. So let me return to say, I started my remarks by shaping a few of the bigger, what I think are key messages in the context of good governance. The opportunity then to go to the boardroom, to go to the role of the CFO, to deliver around assurance, and importantly, to leave key messages about the global accounting profession is truly here, that whilst there's economic and other levels of tension, geo-economic, we're here to deliver stability, resilience. And let me thank again the Good Governance Academy for all that you've been doing in terms of your initiative and priorities. I think there is a tremendous level of similarity, alignment, and integration into what you're doing and what IFAC is doing. And I remain here at your disposal for future engagements as well. Thank you. And Carolyn, if I could pass back to you, please.
Thank you so much, Lee. Wow, what an inspiring discussion and points and presentation. Thank you so much, Lee. That was really, really very valuable. You can see how well it has been received, and I think I will post the brief thing that I showed, the what do you call them?
Yes.
Placemats. I'll share that.
I'm hopeless with slides.
I will share the placemat so people have got the key points, but of course we'll share the recording and the summaries after the session today. But I'd like to hand over now to Stacey. And Stacey, please don't feel pressure to speed up. We really, really do want to hear in detail what you have to say. So for everyone online, it is a pleasure to welcome Stacey, who's the Global Senior Vice Chair of the Institute of Internal Auditors. With over 20 years of leadership in audit and risk management across financial services sector, Stacey brings deep expertise in financial risk, IT security, governance, and regulatory oversight. She has guided boards and executive teams in strengthening assurance, resilience, and ethical accountability. Recognized as a Modern Governance 100 honoree and a Woman to Watch by the MICPA or AICPA, Stacey is widely respected for her commitment to advancing the internal audit profession and mentoring future leaders. Stacey holds a Bachelor of Science in Business Administration from Central Michigan University, is both a certified internal auditor as well as a certified public accountant. And Stacey, thank you so much for joining us, and really our strong alignment with the Institute of Internal Auditors has really borne fruit this year. And congratulations in your recent appointment. Thank you. Over to you.
Well, wow. Thank you, Carolyn. What a wonderful introduction. It's an absolute pleasure and an honor to join you today. I'm really excited to build on my colleagues' presentations and highlight internal audit's role in strengthening corporate governance, especially as organizations face, as all the speakers today have highlighted, increasingly complex and interconnected risks. Our world, as has been highlighted this morning, is marked by volatility, velocity, and vulnerability. And traditional risk frameworks are being tested like never before. Risks now travel faster, hit harder, and ripple further, often across borders, functions, and systems. From cyber incidents to climate shifts to AI governance, threats are no longer isolated. As we've all highlighted this morning, they're increasingly interconnected, systematic, and the scariest thing for us all, they're often unpredictable. This new reality demands a more dynamic response. It demands foresight, strategic partnership, and expanded value from everyone in our organization, especially our internal audit function. This isn't just about internal audit helping your organizations manage risk. It's about working together with boards and executive leaders to help organizations move forward in a way that protects them from harm, that protects them from those emerging risks, so they can focus more clearly on their strategic objectives and ways forward. Get my slides to move for you today. All right. And today I'm going to dig in a little bit deeper on the Internal Audit Foundation's Risk in Focus report. And as we look at this report, I'll highlight the ways that internal audit, with its enterprise-wide perspective, is really well positioned to help our organizations anticipate the disruption that they face, align risk oversight with organizational strategy, and foster transparency and trust in times of uncertainty. Today, we'll look at this research and data, which highlights what chief audit executives and board members say are their biggest risks, as well as where their audit teams are spending their time and energy. And then we'll look a little bit deeper into some of the key points of the data and take a look at the top results that your company should be considering and focusing on as you're thinking about both the risks and, as Lee pointed out, the opportunities that your organization faces. The Risk in Focus is a global survey that the Internal Audit Foundation conducts annually. It focuses on the major risks in organizations and really has some good detail around where the internal audit teams are spending their time, and joins it together to give us all better insights around how we can manage our risks in our organization. And respondents provide their view of risks both today and into the future. As you can see, the foundation gathered over 4,000 responses through surveys, roundtables, and in-depth interviews. These responses came from all regions of the world. And the foundation compiles this information not only just globally, but also breaks it out by the regions that you see here on the screen today highlighted. So when you open the report, you can look at the results both globally, or if your organization is focused in certain regions of the globe, you can focus on those regions. And this is a useful report, as I mentioned, for me as an internal auditor, but also for boards, for leaders, and for executives as you're thinking about your risk landscape. Here you can see the 16 key risks that were identified. And respondents not only provided information around their key risks and where their internal audit teams are spending time, but they also focused on their industry. So in the details of the report, you can also dig in to specifics on industries across the world. And while I think this report's a good data gathering exercise that we should read just for our own information as we're navigating our organizations, I also encourage board of directors and executive leaders to compare the results of this survey to what your risk team analysis shows for your company. I think we increasingly have to be careful about taking our own risk analysis at face value, right? We need to make sure that we're comparing to understand if the current and emerging risks that we've identified in our organizations are aligned with those in the external environment. And if they're not, why? I think we have to continue to challenge ourselves, not just in a once a year exercise, but on a regular basis as we navigate the environment in our organizations. Now we'll dig into the details. And one of the things I think will be interesting here is we'll see that as organizations highlight what their top risks are and where their internal audit teams are spending time, I think some individuals would say, well, your audit plan is risk-based, it should align directly. Well, spoiler alert, sometimes it doesn't, and we'll dig into that as well. So this chart is showing you the global risk levels in a comparison across regions. And the top 5 risks in each region and across the globe are highlighted in pink. One takeaway is that the top 2 risks are consistent across the globe: cyber risk and digital disruption, including AI, as we've already heard from our other speakers this morning. Beyond that, you can see some interesting results where risks resonate differently across different regions, including risks related to business resilience, human capital, regulatory change, and one of the topics of our discussion today, that macroeconomic uncertainty. As we look at these risks, we shouldn't just be thinking about them separately. When we analyze them in our internal audit assessments or as leaders of our organizations, we have to remember that especially today, these risks are increasingly interconnected. For example, digital disruption in AI, to me, amplifies all those other risks around it. Just take cyber, for example. AI is making the cyber criminals better, faster, and smarter. And it's changing how we need to respond and the capabilities we need as organizations. It also impacts, another one you can see at the top is human capital. It changes the talent landscape, both the landscape that's available to us and those skills that we need to be successful in our organizations now and into the future. Your internal audit team is a valuable resource for external industry data and analysis, like this Risk in Focus report. But your team should also be engaged in other ways in the external environment. They should be engaged in peer roundtables with other companies similar to yours, industry groups. They should have relationships with external service providers and be plugged into the external environment relevant to your organization. My experience over 20 years has largely been in financial services. So, for example, I subscribe to Bloomberg and it's streaming on my computer every day. Your internal audit leaders should be engaged in what's happening both internally in your organization with their seat at the table so they can understand your strategic vision and direction and can help you navigate and mitigate it quickly, as well as that really important ever-changing external environment. This slide is showing some of the top risk trends, and I encourage you, and I'll give some information at the end on how you can download the report and dig into this, because this is showing the trends from 2023 to 2025, and it shows quite a bit of change. But my opinion, in the way the world is moving today, the results of this report are already different, right? We already see different risks impacting our organizations, and these values are already changing on a daily basis. So as you bring your internal audit team in and they have that seat at the table and they can provide you that great organization-wide perspective as well as their internal and external knowledge, they should make sure they're changing their internal audit plan. It should be changing regularly. If your plan is set once a year and doesn't change, I'd encourage you to do a more real-time assessment of your risks. They should also be providing real-time assurance or advisory work over your key organizational changes. They should be really helping you get ahead of these risks, making sure that they're challenging on the front end of control implementation so that you can get it right in the end and don't have to wait till something goes wrong to go back and fix it. They should be engaged in your strategic vision and direction. Not every place of your organizational strategy is a good spot for internal audit to spend their time, but there are definitely key pieces where they can help give you value and insight as you're trying to navigate the complex environment and accomplish those really important things that help your organization grow and be successful. This chart shows the global audit priorities, and again, a comparison across regions, similar to we showed for the risk side of things. Across regions, it's very interesting. An average of 69% say that cybersecurity is one of the top 5 areas where internal audit spends its time. That's fantastic. And as you can see, some of the other top scoring areas are governance and reporting and business resilience. Personally, I think all internal audit teams should have cyber risk and AI and digital disruption on their audit plans. These should be key components of what I call the 3 legs of the internal audit stool. You have to have your regulatory coverage, your coverage across the organization from your bottom-up risk assessment that gives you assurance across the key activities on that 3 to 5 year period. And then you have to have, as I mentioned, that engagement and strategic objectives and activities as you move forward. You should bring your internal audit team and key things, all AI and digital disruption. If your company is not doing it yet, they can be a good advisor to make sure you have an AI policy that aligns with the organization's objectives and the industry. They can help protect and make sure that you have good process and controls in place to ensure your data is protected with AI use in your organization. And they can provide best practices on AI governance and oversight and help make sure that you're setting up a good framework to implement AI and evaluate opportunities in your organization. This chart is my favorite because it shows me as an internal audit leader, other leaders of the organization, and board directors as they work through where risks are mitigated in their organization, how the risks of the organization compare to audit priorities. Some areas are well aligned, as you see, cybersecurity, but other areas aren't well aligned. If you take a look, digital disruption is rated 16 points higher on the risk scale than it is on the global priority scale for your audit teams. Human capital is rated 14 points higher on a risk scale than from an audit priority scale. And macroeconomic uncertainty is 27 points higher on the risk scale than on the internal audit priority scale. To me, this highlights 2 things. One, where internal audit teams need to improve. For example, as I mentioned, providing assurance over emerging technologies such as AI and the related risks that can really add value to their organizations in that space. But it also highlights where internal audit isn't always the best team to provide assurance over these emerging and key risks of an organization. This is where your internal audit team can help drive a combined assurance approach, right? Clear discussion and engagement from your internal audit, compliance, and risk teams around those key risks of the organization and which area is the right area to provide assurance and oversight. Internal audit can also help drive this in the reporting and analysis that you provide to boards and committees. You know, in my companies, we've done this through providing what we call the combined assurance plan, where you'd line up the top risks of the organization and clearly show your boards and leaders how each of the teams, your internal audit, risk, and compliance teams, were covering those risks for the organization. very valuable to boards and leaders as they're looking to approve the plans of and activities of these key functions of their companies. I encourage you to take a minute to download the 2026 Risk in Focus report. It was just issued in October, and you can dig into the information I highlighted, as well as the large amount of other great data that's in the report. And make sure that you're utilizing your internal audit team and their unique external and organization-wide perspective to help you navigate the volatile risks and, as Lee mentioned, opportunities that are facing our organizations every day. Thank you.
Thank you so much, Stacey. Incredible valuable insights that you've shared with us, and just to show us what is available to us as well in those reports. To say that presentations now are all available on the event page, as well as the links to both the Business Resilience Toolkit as well as your report, Stacey. So thanks very much to all of our keynote speakers. We are going to continue now. Alan has been able to join us, and we have the team. Just seeing is Paul. I'm just waiting for the others to join us. But first of all, we're going to have a break, a 5-minute break. And in those 5 minutes, please, can you think about the questions that you have for Stacey and Michelle and Lee? Maybe we'll bring that into the business forum panel discussions. But after the break, at the bottom of the hour, we'll reconvene and then have a discussion with the panel of business leaders, including Paul Munter, who's online, as well as somebody from Tata and somebody from a South African bank, Nedbank. So please wait, join us again at the bottom of the hour. We've just got a 4-minute break just to give everybody a little bit of a leg stretch as we go into the business panel discussion. And then we will close after the panel discussion. Professor King, if you can just close the colloquium for us today. I see that Bruce has come online, and we'll see everybody again at the bottom of the hour. Thank you very much, everyone.
This is why you need to join the Good Governance Academy today. Unlock a community that's transforming governance on a global scale. The Good Governance Academy is a non-profit global organization dedicated to promoting good governance and collaboration. We align with the UN's Sustainable Development Goals, focusing on conscious corporate leadership and sustainable value creation. By joining our community, you'll gain access to exclusive events like webinars, workshops, and roundtables featuring global thought leaders. Get personalized event invitations, stay updated with community news, and explore our extensive video library. Plus, collaborate on our ESG exchange to create sustainability reporting playbooks. And the best part, it's all free. So don't wait. Join the Good Governance Academy community today and take your governance game to the next level. Visit goodgovernance.academy. Together, Let's create a better world through good governance. This is why you need to join.
Wow, that was a very quick break. Thank you so much, Alan, for joining us. I see we have Bruce. You're welcome to turn your camera on. And Subrata, I'll just reach out to him and let him know that we're joining now. And in the meantime, Alan, I will hand over to you to take us through the panel discussion on a business perspective of what was said earlier on today. Thank you.
Thank you very much, Carolyn. Good morning, good afternoon, and good evening to all the participants at this 14th Geo-economic. I'd like to start by thanking Professor Mervyn King, our patron and founder, for opening today's colloquium. And of course, Mervyn, for your inspirational leadership over many decades, particularly on governance and sustainability issues. May I also thank Dr. Khosa. I'm not sure if he's still on. Yes, I think he is still online. Thank you for your address, Dr. Khosa. And, you know, South Africa is so lucky to have had you as a mentor to both former President late Mandela and, of course, to our patron, Professor Mervyn King. Thank you, Michelle. Thank you, Lee. Thank you, Stacey, for your very informative presentations. You have set the scene, in my view, very well from a professional perspective. And from what you have said, the geopolitical and geo-economic, and I think we should add geopolitical uncertainty, is not just a reporting challenge. It is also a governance challenge for many business leaders and company boards right across the world. And that is the reason, and that is the reason why we have put together an eminent panel to share their views on what the challenges and opportunities mean for businesses and how business leaders are responding or indeed need to respond to them to ensure that their companies remain viable and competitive in today's rapidly changing world. And I would like to sort of come back to what Lee and others have said. It's not just about risk, it's very much also about opportunities. And maybe, as you said, Lee, we should invert the order to talk about opportunities and risks at the same time. So let me start by introducing today's panel. So first of all, we've got Paul Munter. Paul, a very good morning to you. I know it's just after, I think it's very early in the morning for you, but so thank you very much for joining us. So Paul is a professional accountant and the former chief accountant of the United States Securities and Exchange Commission. Paul was also the chair of the monitoring group that oversees the two professional accounting standard setting boards. Subrata Basu, I'm not sure if Subrata's online yet.
Not yet, I've reached out to him. Thanks,
right.
Alan.
Thanks. 25 years of professional expertise in policy and advocacy, and is the general manager, environment and sustainability at the Tata Group, one of the world's largest industrial and service businesses. And Bruce Thomas started his career as a professional accountant and for the past 10 years has been a senior executive at Nedbank South Africa and is the finance executive responsible for external financial reporting and internal management reporting, as well as reporting on risks. I see Subrata's joined us. Thank you, Subrata. Good to see you. So I thank all three of you for being with us today. After our panel discussion, I will hand over to Carolynn, who is our chief executive of the Good Governance Academy, who will facilitate the Q&A with the speakers and the panelists. So let's now start with the panel. To begin with, I'd like to turn to Paul. So Paul, you have been in the profession for several decades, and of course you've seen many challenges facing the business world. From your perspective as a senior leader of one of the world's most important regulators, and as the SEC's chief accountant, what were the principal and or main geo-economic risk that you had to deal with? And how did this impact SEC's regulatory stance?
Well, Alan, first of all, thank you for having me. It's a pleasure to be with you and my fellow panelists today. The U.S. Securities and Exchange Commission, by statutory mandate, of course, first and foremost, is responsible for overseeing the integrity of the U.S. capital markets, the issuers that access those markets, and of course the interests of investors in those markets. But that having been said, as we all know, capital flows are global in nature, and capital allocation decisions are not made solely within the confines of a particular market. And likewise, economies interact on a global basis. And so, from my perspective, as I was operating as a member of the SEC staff and the chief accountant of the SEC, I think that really requires global thinking to be an effective market regulator. Obviously, I think in the last several months, there's been a shift in policy at the U.S. federal level on issues in particular, such as immigration and on trade. And I think as you translate those into what does it mean in terms of risk to markets and how companies ought to be thinking about risk to their operations, I think those give rise to significant business risk, including adequate access to labor and human capital, disruption in and or the need to make changes in supply chain or perhaps relocate certain operations, or sourcing of materials with related price pressures attached to those. I think there also, of course, continue to be risks associated with climate change that are relevant for businesses kind of across the spectrum, as well as other sustainability concerns, even if there might be a reduced focus on the reporting of some of these kinds of things in some jurisdictions. I think the business risks remain there as well. And I think broadly, what is really critical is as companies and as regulators are thinking about risks, it really needs to be thought of in kind of a holistic fashion. I think one of the things that I saw with some degree of frequency that's a bit disturbing is that I've seen a number of examples where companies will approach risk assessment kind of as a series of silos. They'll have one group that might be responsible for thinking about climate risk on the organization, and another group that might be responsible for thinking about cyber risk, and another group responsible for thinking about risks around internal controls and financial reporting, and maybe another group responsible for thinking about other sustainability risks. And I think when risk assessment and risk management is most effective, it is so when it's approached in again a holistic way. And while there certainly needs to be different expertises brought to the table to think about different types of risk, I think it needs to be an integrated activity taken at the organizational level and an organizational wide perspective for it to be effective. And I think that's true not only organizationally, but I think that's also true when I think about it from a regulatory perspective, that as regulators, it is really critical to think about how our regulations are going to interact with those in other jurisdictions. How are ways that we can maximize the coexistence of regulations so that the regulatory processes from one jurisdiction to another do not inadvertently impose either unneeded costs on participants in the marketplace across various markets, or inadvertently reduce the quality of information that is available to those who are trying to make efficient capital allocation decisions.
Thanks, Paul. Can I just, thank you very much. And I think Stacey also talked about this holistic approach to risk management and the oversight of that. And certainly I sit on a number of boards, and I see that we're now all working much harder to make sure that nothing falls within silos and it's all joined up, integrated and holistic, so that we get a proper oversight at the board level so we can discharge our governance responsibilities to the investors and other key stakeholders. But the topic of today's sort of colloquium is risk in a fractured world, and you talked about how regulators need to ensure that they remain joined up right across the world, because you said these risks they're not limited to particular geographies or industries. They're global, as you pointed out. Do you sense, I know you retired from the SEC earlier this year, but do you sense there is a risk with the pressures that governments face today, regulators face today, that there could be a fragmentation of that integrated oversight from a regulatory perspective?
That is certainly one of the risks that are present today. I think one of the things we're seeing, not just in the U.S., but I think in some other jurisdictions, is a more of a nationalistic focus rather than a global focus, and I think that does create some significant risks and significant pressures on regulators who are trying to think about things from a global perspective, since ultimately the national regulator is responsible to answer to the policies of its jurisdiction. So yeah, I think that does create an additional risk. As you say, I'm no longer in the throes of that, but certainly the people that I dealt with over a long period of time as individuals were very attuned to the risks that were created if regulators get too siloed and attempting to make sure that at a minimum the lines of communications remain open, so that where there are opportunities to work together, the relationships and the ground setting has already been done.
Yeah, and I think I'll probably try to pick that point up with Bruce and Subrata, because from my perspective, sitting on two company boards that operate globally, we have operations right across the world, it is significant, and we are in two regulated industries, very significantly challenging for us to deal with the fragmentation of the way regulators regulate. It's not just the cost, but the delays in getting approvals, et cetera, et cetera. So it is a challenge. So hopefully, Subrata and Bruce, when I come to you, please, if you want to reflect on that as well, that will be extremely helpful. So let me turn to you, Subrata. So as I mentioned earlier, Tata is a very significant global business. You have revenues of over $180 billion and a market cap of over 300 billion. So, and you operate, if I'm not mistaken, in sort of well over 100 countries. So a very significant business in its own right. I think you have 31 companies across your verticals, and you cover technology, automotive, consumer goods, and retail. So I'm sure as a group you face many challenges today, from the geo-economic risks and maybe even the geopolitical risks across the world. And of course, I think most of us know about the recent significant cyber attacks in the UK. Your UK business, JLR, was significantly affected, and I know you're trying to get back on track, but it just shows you that when you do get hit with one of these nasty attacks, not only is it very expensive, but it takes a very, very long time to recover, and hence, things like resilience come into play. But can you just please share with us how you determine the principal risks and how these are managed both at an individual company level, but also at the group level at Tata?
First of all, thank you for having me here. And that's a great question. But before that, full disclosure, because we are talking about ethics and integrity, so I'm a very new entrant to the data group. Yet to finish my year. So what I would like to add that I really like when we talk about the silos create the problem, and what I observe, the biggest thing is that even though there are different entities across geographies, we follow all arm's length principles, but what we don't have is no silos when it comes to values and principle, and possibly that's why we maintain a coherence of generic risks, which for some time some are conventional, but we also be very careful about specific risks across geographies, businesses where we play. So as you rightly said, it is established in 1868. So quite an old company. It has pioneered a lot of such activities in the country in the form of regulations as well. And working in 10 verticals, 31 companies, and hundreds of listed entities actually that follow these risks and necessary mitigation strategies. So what I actually observe that we do is that it's a prioritization with the nature of businesses, with due respect to prevalent standards and a framework that we make for ourselves. And so some of the risks that we still have, which are conventional, like financial risk, macroeconomic, market risk, and operational risk, etc., which you're very well aware of. But there are some risks which are evolving with the business, like the more exposure to the AI, etc., that is happening, the climate risk, so on and so forth. My observation, every entity has well-defined risk management framework aligned with the group ethos and group principle code of conduct. So we don't have silos, as I mentioned, and such framework is a very systematic approach in identifying, assessing, and control. Yes, of course, there is a long-term plan, there is an immediate plan to respond to any crisis. But I think, as I said, the legacy of this experience that we have over 100 years and many geographies, I think we are quite perceptive about the future risks across businesses, and that really helps us. And we combine them at the group level and implement them through individual companies. I think that's what we do very well.
Thanks, Subrata. Can you just comment on the point I made about how the risk of regulatory fragmentation might be impacting your operations? Are you able to share any insights on that, and indeed how you manage and respond to that?
So, in my view, I mean, it's very tough to talk about a specific company within Tata Group. We work across geographies and verticals with different regulations and practices. So I think I personally feel is that sometimes the fragmentation happens also due to the political nature of the market. And then the biggest learning that I would say, having worked in the Indian marketplace for quite some time, I may actually say India itself is a combination of a couple of countries given the federal structure of different states, etc. And the fragmentation is something I think we do by experience. And fragmentation not necessarily contradictory or opposing to each other. It's always doing it in a different way. So I think we have a very good experience, and we manage that knowledge very well. We anticipate the risks which are unforeseen. We do our knowledge management pretty well, where for especially the conventional risk part of it. So I think in the fragmented world, not the hyperactive geopolitical risk that is coming every now and then in a connected world. But I think what I see is that given the market that we deal, that is in India, where there is a regulatory variance, I would say, okay, among the states, among the markets, among the consumer segment, etc., based on the product. I think that gives us a lot of edge of having experienced that and implement that across businesses. So it is kind of our business as usual plan all the time.
Okay, thank you very much, Subrata. So Bruce, my turn to you. Good afternoon to you. So you work at Nedbank. It's one of the largest financial services groups on the African continent. And of course, apart from the specific continental challenges, you are no doubt also facing challenges beyond the African continent, as we've heard already. These issues are global in nature and affect all parts of the world. So are you able just maybe to share with us, obviously only things that are in the public domain, what the most material risks are to Nedbank and, how have these changed over the past year or two and, what opportunities do these risks present to you?
Yeah, thank you, Alan. Just in terms of outside the most material risks that we see, at the top are sort of top 10 risks. The first one is strategic execution. I think that really talks to the point you raised at the start for our board. Opportunities is actually the biggest risk, that as we've got this world that is changing so fast, and the sort of fragmented nature of the geopolitical situation, that
Hello, have we lost?
I think we have. I'll reach out to him, Alan.
Is that? It's not me. Okay, I was not sure whether that was from my end. Let's just see if we can. You're not going through load shedding, I hope, in South Africa at the moment.
Not at the moment. But perhaps we can come back to Bruce. Thank you.
Yeah. Yes. Okay. Bruce, you're back. You're on mute. You're on mute, but you're back. Yeah. Thanks.
Apologies for that.
No, it's not load shedding, I'm told.
No, it is, thank goodness, not that. It's so, yeah, then sort of underpinning that, we would say we've got our overall sort of business and geopolitical risk. So understanding, that markets are changing and we've got to adapt to that. And then really looking into cyber risk being the next sort of thing as a bank in a digital economy, in an open economy. We've got to be constantly ensuring that we are world-class in terms of our cyber risk standards. But it represents, with cyber risk, that it's what consumers want and need. So you can't shy away from a risk. It's not that sort of idea of, okay, is this a risk I don't want to take, and so I'll avoid the risk. I think in the modern world, certainly for us as a bank, you have to be taking on that risk and managing the risk. Otherwise, you don't get those opportunities. So for us, it's definitely, an integrated way of seeing how these risks react. What we have seen is strategic execution risk over the past couple of years has climbed up steadily. I think, coming out of the crisis, we were a lot more focused on the business environment. But as South Africa's government of national unity has started to stabilize, as things like power supply have stabilized, we've seen that need to execute on a strategic level sort of climb up that priority for the board.
Right. Can I just ask you, Bruce? So thanks. Strategic execution, cyber, clearly, that they are risks that I guess all companies are dealing with at the moment. Can you tell me, in terms of, across the continent, because obviously you have ambitions to be a big sort of player across the continent. What are you seeing in terms of the human capital risk? Because Stacey mentioned, in one of her charts, she showed the risk, the human capital risk, which wasn't necessarily always fully addressed as a priority by internal audit, according to a chart. But are you seeing those risks within your organization in terms, and how it helps you in terms of your strategic execution? Hello? I think Bruce is frozen, if I'm not mistaken.
Yep, I think Bruce is frozen.
Okay. Then let's move on, and when he comes back, we'll get back to him. So maybe I could just now let's discuss, how company boards are embedding risk management. And sorry, Subrata, you're the only one at the moment who's Bruce, you're back. Not sure what's happening, but
also not sure. So apologies for that.
But so my question related to, strategic execution, the importance of, human capital. Stacey mentioned in her presentation, high that, on from the risk assessment side, that human capital was a fairly high risk. Are you seeing that in your particular business as you sort of extend your operations and meet your clients' needs across South Africa and beyond?
Definitely. I mean, we kind of sit in two ways: the shape of the skills base of the organization. So we are seeing that you're needing to hire more skilled technical experts, bring those in, people with AI skills, with customer experience type of skills, abilities to do digital coding. So all of that comes with a different sort of skill level. And we've seen it in our cost base that, as much as our headcount has shrunk, roughly about 10% over the last 6-7 years, largely through natural attrition, we've actually have seen those costs grow ahead of inflation as that sort of war for talent has gone on. And I think that's something that's not unique to Nedbank, and you've seen across the financial services sector as those new skills are needed, and there's a sort of demand is higher than the supply of those. So I think truly important to invest in people, invest in skills, because you're not going to be always able to hire in these skills.
Sure. Yeah. And I think that brings to another sort of challenge, which is in terms of integrity and things like that, which I'm sure we can come back to shortly. But what I'd like to now do is just move into the board and understand how both of your companies are sort of effectively embedding risk management in everyday business. Because we all know it's not something that you just do on the side. It's got to be part and parcel of how you manage, you run, and execute the business plans. So maybe, Subrata, could I maybe just ask you, if you can, just, how does the board know that the risks are fully identified across your very large group? And, how are they managed? How do you know that they are managed effectively? And, what kind of frameworks might you be using to ensure that? Subrata? Have we lost Subrata? No, he's there. Subrata, did you hear me? Hello, you're on mute. Hello, Subrata? Paul, can you hear me? I just want. Okay.
Can you hear me now?
Yes, yes, thank you.
Sorry, my system just shut down.
Okay, you need to speak to your tech division. TCS, Tata Computer Services. Over to you, Subrata. Did you hear my question?
Yes. No, I couldn't hear your question. Can you just please repeat it?
I wanted to now sort of move the conversation into sort of the boardroom and really try to understand, how your board is sort of embedding risk management, and how does your board know that the risks have been fully identified, that they are being managed effectively, and if you can share with us what kind of frameworks you use to ensure that.
Okay, I hope you can hear me.
Yes, clearly, thanks.
Yeah, okay. So that's actually, I would say, easy. So India, as per the corporate law, you are supposed to, within the regulation that Government of India has for corporates, you have to define a risk management framework, okay? And then board will be responsible to oversee the framing and implementation of the same. So there is no country specific standard per se, like ISO or COSO and like that. But what we take in, at least some of most of the organization, is take the essence of those global framework and create as per the regulation, we create our risk management framework, and then the board actually is responsible to oversee the implementation, and they are also answerable to the regulator, whichever sector that the company is. So this is pretty much in place for every single registered entity in the country. So the framework is well in place for all the companies, and regularly board reviews and delivers to the respective stakeholders on its deliverables. So that's how all the companies operate here.
Right. And how does the board know that further down into the organization that your companies are complying with your risk management framework, that the reporting is timely, transparent, complete, etc.? What mechanisms do they use? Is it done through committees? Is it done through the audit committee? Is there a risk committee on the board?
So actually there is a risk officer identified in every organization, especially the big one, and for small one it is combined with other functions, but they are very much, responsibility is very well placed, and with a team to continuously report internally, okay, and that's the internal mechanism every company they have said. So I would say on as a regular update, this flows as I have seen, and that framework is very well manned, and it has also the legacy system of reporting through meetings, etc., but also now has IT-enabled system of regular report with checks and balances. So it is a very well-formed system that we are in place. Because I will just mention one thing, because one or two of our technology companies, like the likes of TCS, etc., we provide risk management solutions to companies across the globe. So that's why such frameworks and the such SOPs, a standard operating procedure for the complete reporting system, is very well framed for our own companies as well, I would say.
Thank you very much, Subrata. Bruce, may I sort of pose the same questions to you?
Yeah, thanks. Yeah, from a Nedbank perspective, I think the way we approach this is from a distributed leadership perspective, and the board is sort of very supportive of the fact that we have senior leaders that are tasked with owning the risks, and we run a 17 risk enterprise-wide risk framework. But what's key about that is each of those risks are tied into a group exco committee, and those group exco committees are accountable to the board, but accountable to each other. So you get this distributed leadership happening that ensures that the responses to risks are appropriate at the business level and that they can be succinctly explained at the board level. So I think that's something that's quite important for us, is that link between where the risk originates from and where the risk is managed, and that those who originate the risk are held accountable for how they risk manage.
Right, thank you. Paul, I mean, from your vantage point at the SEC, obviously the SEC oversaw a lot of the sort of corporate reporting. Do you have any observations based on both on what you've heard from Subrata and Bruce, but generally, from your time at the SEC, where were the areas you think companies needed to be focusing on and improving further?
Yeah, and I think both Subrata and Bruce provided some really good examples of approaches that I think are really good. When I was still at the SEC as the chief accountant, we actually issued a staff statement on this question of thinking about risk assessment holistically, making sure that those charged with governance are engaged and understand. Management had well-defined processes, that it was coordinated with the corporate reporting processes and the like, so that there was an integrated approach and a common approach to telling the story. And it's really interesting because all of that grew out of conversations that we were having with some fairly sizable companies, and some shortcomings that, frankly, we had identified with those companies in their processes, where they might have had some significant disconnects in terms of the degree of involvement by those charged with governance, or the lack of integration and coordination between the risk assessment and the corporate reporting and consequences of that. So I think there are, while Subrata and Bruce provided some really good examples of good practices, I think there are shortcomings out there, and it's always useful for companies, management, those charged with governance to do a refresh of their thinking about the risk assessment process, the effectiveness of it, the coordination of it across the organization and the like, because I think in several of the circumstances we were running into, it was, processes that have been put in place, a number of years back, and while those processes might have been effective at the time, circumstances change, complacency begins to take hold and the like, and can result in some pretty important shortcomings in the organization's risk assessment process and effectiveness in managing and communicating the risks.
Yeah, yes, and our presenters earlier were talking about speed of change and the importance of agility, and certainly my own experience is some of these challenges that we face in business, the speed with which they impact you is much faster than it would have been in the past, and therefore your ability to respond and your capability to respond needs to be much more agile and much more timely than it might have been in the past. So yeah, thank you very much for that. What I'd like to now do is maybe just shift the conversation into another very important area which we've touched on, or everyone's mentioned so far, which is this whole area of ethics and integrity, and how businesses sort of should safeguard those very high ethical standards, particularly in politically complex contexts that we live in today. So Paul, I know you just finished, but let me come straight back to you if I may. As previous chair of the monitoring group, you oversaw the development of ethical standards for professional accountants. And, for those of us who are professional accountants on this colloquium today, we really do appreciate the importance of having those standards to guide us and also to help us in discharging our responsibilities, because it's a good baseline which we can look to and use to guide us. But do you see a role for an international body to set ethical standards for those charged with governance beyond those that exist for the accounting profession? And I ask that because as I, sit on boards, and we all sit on boards in various guises, often there are not more than one, and if you're lucky, two professional accountants on the board who have got the responsibility to uphold these professional ethical standards that we sign up for as professional accountants. So, is there a role for some international body to set some kind of frameworks and guidelines and principles for ethical standards?
Yeah, it's a really good question. I think, Alan, the example you give is a really good one. I mean, you and I, as lifetime members of the accounting profession, of course, are well accustomed to being cognizant of our professional responsibilities and have a lifetime of ethics being part of the core of who we are and how we operate. But as you say, when you get beyond the accounting profession, there's not that same well-defined code of professional responsibility that exists for others. Now, obviously, we've dealt with a lot of different individuals, and I've dealt with a lot of people from other professions that were highly ethical professionals. So I'm not by any means intending to disparage others, but it's different from having a well-defined framework. When we've had these discussions in the regulatory world, at least when I've been engaged in discussions in the regulatory world, first of all, as I mentioned earlier, there's a lot of information sharing that goes on, and I think is very helpful. But I think one of the things that exists is either the existence of governance structures or the responsibilities of those charged with governance can be very different from one jurisdiction to another, which makes it a little more challenging to have some kind of a global ethical conduct structure. That being said, IOSCO, several years ago now, 5 or 6 years ago, I guess, issued a set of principles for responsibilities for those charged with governance. It's not, a full code of professional responsibility as we would think about it from an accounting perspective, but it's a starting point of what kinds of expectations jurisdictions should be thinking about in terms of responsibilities of those charged with governance and the importance of ethical conduct to the fulfillment of those responsibilities. But I think your question is very good. Is there a need for some kind of a global structure to that? And I think that would be very useful. I think the question would be, who would be empowered to take on that responsibility. I do know, of course, there are several corporate director type organizations that exist both at national levels and in some cases internationally. So as I think about your question, I think it would be really useful for regulators to engage in discussions with those kinds of organizations. First, for fact finding, what does exist today, and what kinds of codes or expectations are there within some of these organizations that might be either a starting point or an inventory that can be gathered up for more information sharing. And is there, I'll call it a natural organization to step in here? So I think it would take a fair degree of work. It would obviously take commitment of a number of different organizations across several different platforms and geographies, but I do think it is something that is well worth thinking about as jurisdictions and kind of multinationally organizations think about the role of those charged with governance and therefore the responsibilities and characteristics of individuals who are serving in those important roles.
Yeah, thank you very much, Paul. That was a very comprehensive response, and it's something that you and I have discussed in the past in our previous roles. Can I maybe just come to you, Bruce? As we know, and we've seen it so many times in the last 20 years or so, the integrity of the financial system, whether it's at the country or regional level, is critical to economic and social stability. So, how does Nedbank ensure that, irrespective of where you operate, whether it's in South Africa or beyond, that the bank is able to uphold the highest standards of ethical behavior within your business? And, there's always this challenge between, being competitive and compliance. Do you find that, these two things collide? And if so, how would that be potentially sort of managed? Bruce, you're on mute.
So,
Did you get that, Bruce?
I did.
Thanks. Okay.
Hope you can hear me all right.
Yes, clearly. Thanks.
All right, great. Thanks, Alan, for the question. I mean, it really for us starts with leadership, a sort of stated commitment to ethics and leadership from the board. And I mean, I think you talked about a couple of things, but as Nedbank, I mean, we sort of at this point, I would like to say thank you to Dr. Khosa for his leadership and legacy that he left at Nedbank as a former chair of our board. And I mean, you can see that legacy in the way that the corporation sees itself and how we approach ethics. And I mean, also, if we look to, as a financial system in South Africa, we've been very lucky to have excellent leaders, one of whom was our late chair of our Group Risk and Capital Management Committee, Errol Kruger, who was the previous registrar of banks. And I mean, his leadership during the global financial crisis ensured, because we took an ethical stance as a financial services sector in South Africa, that we avoided the worst of those excesses. I mean, I think the position that sort of you put it, is there a trade-off? I think we would strongly challenge that and say, no, we don't think that there is a trade-off between the sort of values of being ethical and the way that we see it is we have a stated purpose of using our financial expertise to do good for individuals, families, businesses, and society. We clearly have got an obligation to our shareholders to generate adequate returns for the risk they take. But we've also got obligations to our employees to pay them fair compensation for the work they perform, obligations to our clients to provide them with the services they need, as well as to our regulators and society to, look after the financial resources that we are entrusted with in a responsible manner. But all of that really is sort of underpinned by this leadership that says this is who we are, and that we really prioritize the long-term sustainability of the organization. And here I'm talking about that long-term value creation. And I'll sort of end off in the way we sit, and our CEO loves your sports analogy, so I'm certainly going to use one. We all want our favorite team to win, but I mean, we certainly do not tolerate a team that cheats or an individual that cheats in sports. We sanction them. We spend a lot of money around ensuring that we have clean sport. And I think the same should be true in business, that, it is good to win. but it is also very important that it is clean, ethical businesses that are winning.
Thank you very much. Very good to use that sports analogy, given the importance of sports in South Africa. So thank you for that. Subrata, so just coming to you, I think you mentioned that you've been around since not you personally, obviously, but the company's been around since 1868. So that makes it coming up to 160 years or so in a few years' time. And I'm sure that over many decades, your company has faced some ethical challenges. How do you manage ethical challenges at Tata Group?
I think I will, the two words that Bruce just used resonates very well with us as well. One is the leadership style and the legacy. Okay, both are very important, starting from the 1868 that company has been built. And then all this leadership style and the legacy, as I said, is embedded in a very well documented code of conduct, okay, which has the ethical roadmap, say, or guideline that encapsulates basically the integrity, responsibility, and excellence. And it has clearly states the macro variables and the non-negotiable part of the ethics in our code of conduct. So highest moral standard of corporate governance as per the regulation, even beyond it, respect human rights, dignity, professionalism, etc. So it is very well defined at the group level. And of course, as I said, they have the code of conduct is prevalent in every single entity within the Tata Group. So I think creating the uniformity in approach, the leadership style that learns from it, and the legacy that has been built through that has, I would say, that it has been very embedded into the culture, and we really always 100% maintain this in our business practices. So I think that is how, as I see that, yes, we have guiding light, our code of conduct, but it is also embedded deeply into the culture in our practice, and that's how we actually, I think that's how I see that we manage this part.
Thank you very much. And I would assume that one of the significant opportunities of doing it well is that you attract and retain the best talent in the marketplace to want to work for Tata Group and of course for Nedbank in South Africa. I'm conscious that we're coming up to the end, but I would like just to explore one final point, which is to do with business resilience and financial integrity. Given the significant geopolitical risks and the challenges from, for example, cyber and other attacks, could you just maybe briefly explain, starting with you, Bruce, how are you building resilience into your operations?
It's from a resilience perspective, I think it's getting attention from the board, right from the top, to say that, when we look at particularly a number of the sort of cyber trends, it accelerates the need to be resilient. And that's emphasized by what Paul was mentioning about, you might have processes that are in place, but are they fit for purpose for this changing world and the pace of change? So that's the sort of first pieces are really around a leadership position on the need to build organizational resilience in. And then we would say it more at an operational level when we look at how do we ensure sort of financial integrity and being resilient. And all of that for us comes down to like a key question of how do we build trust in what we put out. And that could be trust internally. So how does the board have the trust in the information it's getting to make quick decisions? which is part of being resilient, is that ability to get the right information at the right time. So you've got to work hard at your processes, the way you do it, and the people that you have, investing in them to build that trust. And then when you go to market, it's very much the same, that the markets are able to, and the capital markets, where Paul really started this from, the importance of those capital flows, that we provide information that's implicitly trusted, and capital flows can make decisions to allocate capital effectively, so that, you know, as organizations and as societies, we can continue to grow.
Thanks, Bruce. Subrata, anything to add to that? You know, given, you know, your very recent example in the UK, has that sort of increased the need to look for even further resilience in your operations?
Yeah, and I mean, the UK is very specific to the advancement of that. I mean, more and more exposure of businesses to and the learnings therein in the tech world. Okay, so cyber attacks, politically motivated or otherwise, have been rampant in many parts of the world. So that is quite specific, and yes, we learned from it. But I think the approach to build resilience in such specific things is basically, we focus a lot about data analytics, scenario-driven preparatory work in advance. And so in a connected world, we always have to have many chances of interdependent risk happening at the same time and more frequently, as I say. So I think this, I do not have any specific comment on this cyber attack. It is already very well known to everybody, but the learnings from this is that more and more exposure is happening due to the connected world and the exposure to the technology, but that is also the biggest opportunity around the corner. So I think our learning is that the preparedness needs to be even more stringent, and it is beyond the regulations that we already see in various markets. And that is what I see. I would add that as our learning from this.
Yeah, thank you, Subrata. And I know it's been very challenging, but I know because I also know the new MD of JLR in the UK, and I know everyone's working flat out, not only to fully cover to meet your, you know, the demand of your consumers, but also to ensure that you know, build even stronger and robust firewalls around the business. Because, you know, one of the opportunities is you increase the use of technology, which is great in terms of efficiency, speed, responsiveness to consumer demands. But that, of course, in itself brings additional risks of exposure to these terrible attacks that attack your operational technology, etc. So, you know, I'm really sorry for what happened, and I wish, of course, all of you well going forward. And you know, you're taking the learnings to heart. So thanks for that. Paul, just coming to you before we close. So, you know, you've listened to the, you know, the business leaders. So what advice, you know, would you sort of be giving business today regarding maintaining sort of high levels of financial integrity in the face of this rapidly changing risk environment?
Yeah, I think, and Bruce was touching on some of my thoughts here as well. I think, and it comes back to the point we were talking about a little bit ago, Alan, and I think Subrata was describing this very well in his organization. The first and foremost, ethics has to be, a core, at the core of what the business does, and so that it is, as an organization, which means obviously the individuals within the organization are fulfilling their ethical responsibilities and acting with integrity and the like. And then as you kind of migrate that to the corporate reporting side, I think it is very critical that that commitment to integrity, that commitment to transparency and the like be fundamental to that. In my first stint at the Securities and Exchange Commission, I joined the staff in the immediate aftermath of Enron, WorldCom, those kinds of very high profile corporate reporting scandals, and the consequence, of course, was a crisis of confidence among the investors in the marketplace, which has real tangible effects. They demand higher cost of capital and the like. It obviously impacts share values, et cetera. And so I think it is vitally important that businesses think about integrity and ethical conduct, not only in terms of how they conduct themselves in their day-to-day operations, but how they go about their corporate reporting responsibilities and how they view it. It really needs to be looked at as a communication activity. And obviously there's a compliance aspect to it. And I know you serve on not only boards, but audit committees of organizations. So yeah, there's a compliance aspect to it, but it's not a compliance exercise. It's a communication exercise. And if we don't have ethics and integrity at the core of the operations, and that also being embedded in the approach to corporate reporting, then collectively there is a risk to investor confidence, which has then tangible effects on companies' access to capital and or the cost of accessing capital.
Thank you, Paul. So we've come to the to our time. May I just thank you, Paul, thank you, Subrata, and of course, thank you, Bruce, for your engagement today, for preparing prior to today, and for sharing your thoughts, insights, and experiences. Really very helpful. I'm going to hand back now to Carolynn, who will facilitate the Q&A with our participants. So thank you again for your time, and Carolynn, over to you.
Thank you so much, Alan. Wow, what a lot of food for thought. We've got a tremendous discussion on the chat and in the Q&A. So it's really got a lot of following and a lot of interest. I've got a couple of questions, and Alan, there's even one for you. So thank you. First of all, thank you so much for facilitating and moderating the panel discussion today. Just coming in at in the situation you're in. So thank you for that. All right, let me start with a question from Kerry, and it's a question that I'd like to put to Paul. Do you believe that boards should prioritize anti-fragility spending? So now anti-fragility is defined by, and Kerry references Nassim Taleb, as the ability to grow stronger through volatility and stress. So should boards prioritize anti-fragility funding rather than focusing on maximizing short-term financial gains? What do you think?
I guess the way I would try to answer that is it depends, but I would say that certainly boards need to think, as they're working with management on strategic objectives and the like, they certainly need to think about long-term perspectives. Now, achieving long-term objectives is ultimately going to be accomplished by a series of short-term decisions in terms of funding and spending priorities and the like. So there has to be an integrated way of thinking of understanding what are the objectives that will help the organization be sustainable and continue to be successful, and then what are the steps that need to be taken and the near-term spending and funding commitments that will need to be undertaken in order to best facilitate the organization's ability to achieve its longer-term strategic objectives.
Thank you, Paul. Thanks very much for that.
May I just add to that?
Yes, please, Alan.
I think it's a very good question, and one that boards face all of the time. And just to build on what Paul says, I never believe that you can achieve your long-term objectives unless you actually achieve them in the short and the medium term. And therefore, I don't think there should be a trade-off between what you do today and what you do in the next few years, because I think what you do today is fundamental to you being sustainable and being competitive to deliver your medium to longer term strategic objectives. So I think that's a dialogue that, you know, boards will have to have with investors, you know, in terms of what do we do today, you know, in terms of investing for the medium to longer term, and how that might impact the volatility of earnings in the short term, and just helping investors understand that. But it needs to be properly, you know, Paul talked about communication earlier. It needs to be properly communicated. We need to help investors who don't always necessarily understand the cadence of business and the volatility. It's our job as business managers to explain that and justify why we need to invest in short-term resilience, which won't necessarily give you an immediate payback. But if you don't do it, you're not going to get any long-term return going forward, because you'll actually probably be out of business.
I'd like to then put Bruce on the spot here. And I know, Bruce, your mic is off, but as a Nedbank is an award winner for integrated reports and communication of this kind of dilemma and this balancing, that must be something that's difficult. But what did you want to add?
Yeah, so on the previous point, I was keen to say our sort of CEO says he's strategically patient but operationally impatient. So I think it's really that idea of we need to do things today, the results will come in the medium and long term. But yeah, sort of building on some of the other questions around how we've done sort of integrated reporting, and for us, the integrated thinking has been the key part of, you know, trying to ensure you've got teams across the organization bringing diverse ideas and thoughts to the table. And I mean, for the one core decision we've taken is we never outsource the core message. You know, we bring in experts to help us, but it's authentically needs to be our message that our leaders, both executive and non-executive, are comfortable of sitting down in front of any investor, any stakeholder, to be honest, and having that honest dialogue of why are we doing certain things, and they can at the heart explain sort of this trade-off that where Paul and Alan were starting between what are the short-term actions we're taking for the long-term strategic vision.
Thanks, Bruce. I want to segue into another discussion, and it's a question to Michelle, actually, from Valerie. Michelle, from AICPA's global advocacy perspective, how do you see the evolving balance between internal audit and risk management functions, in particular when organizations choose, and you were talking about outsourcing, Bruce, and outsourcing the core message. So, Michelle, in particular, when organizations choose to outsource internal audit, how can they ensure that this still supports the robust combined assurance model that strengthens governance overall rather than fragmenting it? It's a difficult question. Is it something that you can answer off the bat?
It's a tricky one. I'm very sorry that Stacey's not with us. She'd have a fantastic answer for this one. I think we have to look at this environment in the holistic piece, because we've all got a role to play. An internal audit is very, very important in terms of that line of defense. And, you know, keeping businesses accountable, because we talked about accountability elsewhere. So there's an ecosystem which starts with corporate governance, and then it moves to corporate reporting, and then it moves to audit in all of its shapes, whether that is internal audit or external audit. And I think it's the relationship of corporate governance to corporate reporting, to internal audit, to external audit, that is very, very important. So not just to focus on the audit perspective as the process. And I think, if I'm being honest, in the last 10 years, we've had a lot of conversations about audit around the world. And in times of crisis or instability, or when, you know, poor decisions then come to light, very often the first thing that happens is the question is, where were the auditors?
Yeah,
and it's more
absolutely.
important. It is more important to think about this in the context of that corporate ecosystem, which starts with good governance, which starts with accountability, transparency, strong ethical leadership, which then translates into integrated thinking, strong corporate reporting, which then translates into a very strong first line of defense in terms of internal audit, which then translates into external audit. So I don't think I have answered Valerie's question per se, but I would reinforce that it is much more important in this environment, given all of the various dynamics and factors at play, that we do not lose sight of the really strong importance of governance. It is the start of that continuum. The audit piece and the internal and external audit comes at the end of that ecosystem.
Thanks, Michelle. And then Subrata, if you're still online, I'd like to pivot this through to you. The question was really, how do you get these lessons learned from the various organizations you have in your group, like lessons around internal audit, governance, etc., and how does that filter up and across the group so that there is a collective learning and improving and continual improvement across the group?
Yeah, that's actually a good question, and that's easy for me to answer because I sit in the headquarters in the corporate. Okay, so and that is what we do as a to maintain that group level macro uniformity. Okay, to gather all the learning, creating the set of best practices, and share it back, and continuously maintain that feedback loop. Okay, and that's at the group level. We always have, even though, as I said, we are different entities across the world, we maintain the arm's length, we maintain all the regulatory principle while we do business transaction. But when it comes to knowledge and best practices, we are all very connected through our group company headquarters. Yeah.
Thank you, Subrata. It's really important. Actually, Mervyn, there's a question for you, if I can. I know you're not part of the panel, but the question was about Steinhoff. And the question is, what went wrong with Steinhoff when there were so many accountants on the board? And you're muted. Sorry, let me just unmute you. There we go.
Yeah.
There we go.
Steinhoff, of course, was registered in the Netherlands, so it had a dual board structure. You had the non-executives at the top and the supervisory board, and you had an executive board at the bottom, chaired by the group chief executive, Mr. Jooste. And there were several accountants in the supervisory board at the top, but that dual structure, I think, has a weakness. And I'm all in favor of the unitary board structure of the Anglo-Saxon countries, because you actually can eyeball your chief executive and the other executives and ask them questions there and then. But the supervisory board doesn't have that opportunity. And what happened was that Mr. Jooste, so it was alleged he committed suicide after it was discovered, pumped up the value of certain properties overseas, got valuators to say that was correct, and added to the asset base of the company, and then also increased sales by using offshore companies. So there were accounting and let's call them dishonest transactions conducted by Mr. Jooste with the complicity of certain of his executives. So what was presented to the supervisory board were not the facts of what was happening. It was in fact a glossed over report. And when they finally started asking questions, the supervisory board, Mr. Jooste was unable to produce enough evidence to support his reports to the supervisory board. And that is when the whole house of cards fell down.
Mm.
And Mr. Jooste eventually committed suicide when he was about to be arrested and charged with fraud, not only here, but overseas as well. Not only in South Africa, but overseas as well. So the answer to the question asked was that PwC was charged with investigating the whole matter and found that because of this obfuscation coming up from the executive board, that the supervisory board actually was innocent of these, had no knowledge of these fraudulent activities.
Yeah. And as Michelle said, it always comes back to them. So where was internal audit? Where were the auditors? So, and I know that sometimes that's not where the blame should lie. But I've got a last question before we wrap up, and it's really to both Paul and Bruce, because you're both in politically charged environments. Africa politically charged. The US today is politically charged. So, are there any practical things that boards can do to strengthen governance and risk oversight to mitigate or certainly manage the economic and operational impacts of this political instability that we're seeing, and both in a South African context as well as in the US context? Paul, perhaps starting with you.
Yeah, I'll give it a try, Carolyn. I think some of this goes back to a point we made earlier, and I think Bruce touched on this as well, which is when you've got a circumstance where the policies are changing pretty dramatically and in a short period of time, the risk assessment processes and risk assessment priorities that might well have been effective and appropriate, let's say 6 months ago, may no longer be responsive and may no longer be as nimble as they need to be in light of a very rapidly changing political policy initiative. So I think it just reemphasized the need to make sure that the risk assessment process is very continually refreshed so that it can be nimble in response to changing risk circumstances, changing political priorities, and changing economic and cyber risks that are growing pretty dramatically.
Thank you, Paul. You want to add, Bruce?
Yeah, definitely. I think we've seen as we've gone through the Zondo Commission how sort of important it is for senior leaders to have integrity and be able to answer challenging questions in a sort of frank and honest manner. And a lot of that emanates from being able to have those conversations internally. That are you having the right conversations sets you up as an organization to respond in that moment of crisis and really to follow through on your commitments. So that really has been sort of key for us is to take that sort of principled decision. It certainly maybe in the short term creates some noise, but in the long term, it ensures that the organization takes the right decisions that are in the best interests of its long-term value creation.
Thank you, Bruce. And I think that's really important. What I'm hearing everybody say is that under this pressure, this polarization, and these factors that are hitting us, in fact, we have all the tools we have. It's just about making sure that we use them better now, So we do have the tools. Integrity, we've spoken about integrity, and we've spoken about using audit and using risk and being better at risk management. So it seems to me like we have the tools. It's just a case of using them properly now. And we're under pressure and we need to use them. Anyway, that's just what I'm hearing. But a question to you, Alan, and this was specifically asked from John. As someone who serves on several international boards, how do you see organizations adapting their governance models today in today's highly diverse and unpredictable models? Has what I've said, using more of the same and being better at the same, or are there different models that are starting to emerge?
I wouldn't say they're different models, but and I want to go back to some of the points that were made earlier. It starts with making sure you have the right people sitting at the top of the organization. And I've just responded to one question that was asked by Harrison about how do boards of directors their approach to leading the business is making sure you have very broad diversity right across the board. You've got people who don't always think the same way, people who've got broad and diverse experiences and expertise that sit around the table. You need directors who are prepared to ask the right questions. You need a board of directors who actually spend time to understand the business, the complexities of the business, the different types of business and the different geographies that you operate in. But going back to what Mervyn said earlier, he has a preference for a single tier board. So do I, but I can also, dual tiers can also work, but I do have a preference, as he does, for a single tier board. Why is that? Because you're all sitting around the same table, having the same conversations and listening to each other and challenging each other at the same time, rather than having another layer where information then has a risk of it being filtered. You're all in the same room and you're collectively responsible for the outcomes. So, I wouldn't say that we need to change very much. We just need to do what we do well and do it consistently right across the organization. And it does start, and I'm going to use a Professor Mervyn King phrase, it starts at the tone of the top and it's the feet, it's the beat of the feet at the bottom of the organization, and everything between the top and the bottom needs to be aligned and completely transparent in terms of what's going on. And we talked about culture, we talked about code of conduct. I think Subrata mentioned that. Bruce also mentioned the importance of code of conduct, but also making sure that people know that if they have any concerns whatsoever, they are empowered to speak up, they are encouraged to speak up, and they must speak up, and you take that extremely seriously. And may not be right, they may be wrong and misunderstood what was said or what they've seen. That in itself doesn't matter. What matters is you give that safe zone, the safety for people to speak up if they have any concerns on whatever they see or hear. And then it's up to the leadership of the organization to make sure those things are properly looked at and actions taken as needed. And that you create that safe culture, safe environment for people to feel that they can be heard, they can be listened to, and they'll be taken seriously. There's no single bullet that will address all of this, but I think it's the integration of everything we've heard today that creates that environment where businesses will do the right thing for the right reasons, for the long term, and will thrive so that societies are sustainable and everybody benefits.
Thank you, Alan.
And I like what Bruce said, and also Subrata mentioned, what is the purpose? And I think Mervyn has talked about this over many decades, the purpose of an organization. It serves many purposes, and it's got to deliver on each of those purposes to be sustainable and successful for decades.
Thank you, Alan. We've run out of time. So just from my side, thank you so much to the panel. Thank you to Michelle. Thank you, Alan, for moderating. Thanks, Subrata and Paul and Bruce for making this time. It's been great having you with us. I would like to now hand over to Prof. King to close our colloquium, and we'll see you again at our next colloquium in May. Thank you very much, everyone.
Well, thank you, and thank you everybody online, and thank you for all the speakers and the panelists for your time and your wisdom shared with us. Bruce talked about legacy, and Nedbank had the good fortune to have Reuel Khosa as its chairman for many years. And Reuel left his legacy of integrity and correct thinking and worrying about the outcomes of how the company was governed, that you could actually see from the outcomes that the company was being governed well. So Nedbank had the good fortune of having that legacy. And Reuel today, in his usual eloquent manner, spoke about looking at risk management in regard to geopolitical issues, on looking at scenarios, but approaching it not with fear, but with diligence and with ethics. And he's correct. We have to deal with these things. We can't ignore them because they're impacting on the company, of which, as directors, we are the guardians of the company's assets and its business affairs. So we have to deal with them from a risk management point of view. Michelle and Lee, in broad brush strokes, I'm going to talk about speakers, others will be here till midnight. But Michelle and Lee were able to show that the accountant is the true change maker in the boardroom. I wrote in 2016 that accountants can save the planet, which caused much debate and discussion around the world. But it's accountants who've changed they've realized that moving away from the primacy of the shareholder, that the creation of profit being subsidized by society and the environment was clearly not sustainable. And accountants have appreciated that the value creation model, which we have now, value creation, perseverance, and or erosion, is the way to go to see if there's true value being created. And Michelle and Lee were able to show that in the talks they gave. Stacey showed that the internal audit profession has moved from a hindsight one to one of foresight. And more today, there are hybrid internal audits of great companies. Hybrid in the sense you have an internal executive who becomes the head of internal audit, but with, say, one of the big four joining that firm as part of the internal audit team. And the reason for that is they use the big firm's balance sheet to use the technologies which have been developed because most companies don't have the balance sheet to keep up to date with the technological advances which the big four have at their disposal and can bring as an aid to internal audit. And that's why combined assurance has become to the fore more than ever. That you have internal audit, let's say this hybrid form that I've described, with one of the big four and one of the big four as the external audit. And they combine in accepting some of the reports of the internal auditor and actually speed up the question of the external audit and reduce costs. So Paul was able to show us and that the SEC thinks on a holistic basis, especially in regard to the US capital markets. Nationally, the regulators think on a more silo basis rather than holistic. But it was interesting that he said there are corporations and there are some great companies in the US that are speaking under the radar, as it were, of not mentioning language of sustainability language or DEI language, but actually still reporting on that and practicing the questions of sustainability, accepting that business is the junction of the economy, society, and the environment, and that they should deal with that. So it is interesting that I was one of the judges this year for the Golden Peacock Awards, and well known from India all over the world that they choose a company that's been acted most sustainable manner. And it was an American company that was today chosen to act more sustainably than the peers in that its peers in that industry. And Subrata pointed out the importance of the influence of legacy, and the legacy of the founder of the Tata Group, the bust that's in the boardroom, main boardroom in Mumbai. I've sat in that boardroom on several occasions for many reasons. His approach was one of sharing the success of the company with society. And he left a fantastic legacy of honesty and taking account of the impact of the company on society and the environment. So the legacy left there is very important from the question of ethics. And although the group operates in several jurisdictions around the world and has this fragmentation of regulation, that legacy is like an umbrella over the Tata Group. And you deal with the Tata Group, you are dealing with a group of great integrity. And Bruce, likewise, Nedbank is well known to me. And of course, I've dealt with the chief executives of Nedbank and for many years with Reuel as chair. And there again, you had the question of leadership, which was so important. And Reuel, of course, left the question of legacy there, very much so. And it was interesting, Bruce said, they've got committees actually dealing with the different risks in their risk management setup. So overall, the colloquium was much food for thought. And as I said at the beginning, I think we all leave this colloquium, Carolynn, more informed than when we started it. So thank you very much to our speakers, our panelists, and Alan, for you who have not been well, for coming in and moderating. Thank you very much. Thank you, Carolynn. You're muted.
Thank you. So thank you, Rookie Era. Thank you very much, everyone. And thanks for staying, to the attendees for staying online. The recordings and summaries will be available on the website later on today, and the certificates of attendance will be distributed today as well. So thank you very much to everybody. Thanks so much.
Thank you.
Thanks.
Bye.
Bye-bye.